Other times we lack the time that's needed to commit to these strategies. And so, that's two different issues that we have with financial planning, and we plan on covering both of those today. And the importance of the financial plan is in the execution, right? The after, determining the most important, you determine the goals, and then how do we execute it? All right. So it's the belief of PB Mayers that integration and experience equals optimal return. Now, when you hear optimal return, most of the time, if it's within this realm of subject matter, you're going to be thinking about market return, right? What am I getting out of the market? But when we talk about optimal return, we're really talking about the entire picture of the plan and the real value, the real return. And so, if we look at retirement planning, just one small piece of the financial plan, anybody can retire. Really, ultimately, retirement just means you stop working. But can you stay comfortably retired? And that's the question that we're asking there. And then we'll go through spend down planning. Am I spending my assets efficiently, both on a tax favored basis and taking into account my time horizon here? And then we'll talk about some family planning, right? Michael will focus on a lot of this later. Something neat that our firm is doing, and I know that a lot of other advisory firms are doing it as well, but how to sort of integrate the entire family in. Is your family aware of the plan if it does in fact exist? And, it's interesting. I was looking at it this morning. Andrew mentioned that I had a 7-week-old. So finally got the Social Security number and everything to set up the 529 plan for her, and just typed in 529 plan instead of going to, Virginia 529 for some reason this morning. And it pops up and it starts to give me statistics about 529 plans. And I was blown away that only 2.5% of households in the United States of America use 529 plans as a planning tool. And so if you think about that statistic, 2.5%, and not everybody has a financial plan, the underutilization of 529 plans is a great planning tool. It's astounding. Then we'll walk into risk management, right? Which is really, are my assets protected? Is my income protected? Yeah, and then we'll round it out with some estate and trust considerations. And I think it's important is that once we look at the full financial plan, we need to recognize that we may not have all these boxes checked. But it's just setting the goal and having a plan and a strategy to start checking some of these boxes. So what we have in here is we have some polling questions just to create a little bit of dialogue around this. And so if everybody just take about 10 to 15 seconds to answer this question of if they have a financial plan or not, that would be very helpful. Terrific. So little interesting tidbit on these results is that it's actually flip-flop nationally. So Schwab's data that they put out says that only 25% of people have a budget, right? And the Gallup poll results that just came out said only 30% of people have a long-term financial plan. So everybody on this webinar is in great shape as far as, the data being flip-flop. We usually see that the other way around.
Okay, so I'm going to take over and talk a little bit about what's called the Monte Carlo analysis. Now, there's a lot going on this slide, but I want to break it down for you and hopefully make sense of it. So now that Brad gave you a bit of background about what personal financial planning is, I want to introduce an important tool that we use all the time with our clients. And this is all across the financial services and financial planning industry. This slide is a visual representation of what we call a Monte Carlo analysis. It has no association with gambling in this sense, strictly for us modeling different scenarios for our clients. It may be hard to understand and figure out what's going on, But what you want to pay attention to is that probability of success figure here in the top left. What a Monte Carlo analysis does is it runs a financial plan's assumptions, in this case, 1,000 different trials of different market conditions to test the strength of your overall financial plan. And from the results we got from that polling question, it seems that most of you are probably familiar with what this is. This takes into account assumptions like employment income, when you file for Social Security, and how your investments are currently allocated. The graphic in this slide indicates that this plan is 99% successful. Now, what does that mean? It means that out of 1,000 trials, 990 of them were successful. And that means that 990 of them have money at the end of life. At PB Mayors, we consider a Monte Carlo percentage of 85% or greater to be a successful plan. All of those blue squiggly lines on this graph, those each represent one individual trial. You can see that in this graph, purple represents an unsuccessful trial. These end with 0 portfolio assets at the end of a client's life. This tool is heavily used in the industry, and simply stated, it determines whether a client is on the right track to meet their goals or if some tweaking to the plan is needed. Now, I'm going to talk about a little bit some of the players that are involved in the financial planning world. We are aware that the industry is full of jargon, and part of our job is to break that down for our clients, and we're going to hopefully do the best we can with that today. So number one on this slide, we have broker dealers. Now, when you think of a broker dealer, think of someone like Fidelity Investments or Charles Schwab. Their primary functions are in the name itself. They act as a broker by executing buy and sell orders on the behalf of individual investors like yourselves, while also being a dealer when it comes to trading for their own account and inventory. From an individual investor perspective, think of them like a grocery store. And the securities you can buy, like stocks, mutual funds, and ETFs, those are the food items. The broker makes their inventory of securities available to customers like yourself, and then processes those transactions to buy and sell those securities. This is the broker functionality, but the other half is that dealer aspect. Just like a grocery store, they need to maintain their inventory of food and make sure that the shelves are stocked. The next player we have in the industry is what's called a registered investment advisor, or RIA for short. And think of PB Mayors Wealth Management in this context as an RIA. So as a company, we advise our clients regarding their personal financial lives. Because of this, we are required to register with the Securities and Exchange Commission and act as a fiduciary for our clients. Michael's going to touch on what a fiduciary is more specifically shortly, but an RIA can be an operation on its own, like PB Mayors Wealth Management, or it can be a part of a broker dealer as well. So that's how those two interact. And then finally, there are those like Brad, Kurt, Michael, and myself who are the financial planners at the end of this equation. We are the individuals that are employed by the broker dealer or the RIA to help deliver those personal financial solutions to our clients.
So like Derek mentioned, I'm going to touch on sort of the importance of working with a fiduciary compared to maybe a broker dealer. Fiduciary has kind of become a buzzword nowadays in the industry. We've talked about the different players in the financial world, but it's important to recognize the distinctions within their required standards of care. So, most broker dealers are only required to meet what's called the suitability standard of care, which means that their advice and their actions must be deemed suitable for the client. That's a broad definition. Which kind of asks the question, are their recommendations most beneficial to you, or are they most beneficial to their company? On the other side of that coin, we have a fiduciary's advice. And a fiduciary's advice and their actions are legally obligated to be both suitable and in the client's best interest. So this additional level of responsibility is something that we as advisors take upon ourselves to ensure that our clients are getting the highest level of care. This next slide is probably the most important slide of our presentation. This is something that we call the hub. It's the focal point. What this is we've aggregated all the various reasons that clients want to work with an advisor. And this is something that we've learned over the years, that just about every single one of our clients falls into one of these 4 buckets, which we call the 4 C's of financial planning. And sometimes a client may fall in 2 or 3 of these 4 C's. Maybe a client's looking for a coach, someone to help keep them in check, make sure their plan's still on track and that they're going to achieve their goals. Maybe someone's looking for continuity. Maybe you'd like your entire family to be involved and ensure that your wealth extends into the next generation. You're looking for convenience. Maybe you don't want to spend all your time worrying and stressing over your financial struggles. Lastly, we have competence, which is someone who may need help. They don't know what they're doing and they're looking for the assistance of experts. And a main part of our presentation is each of us are going to dive into some of these characteristics, starting with coaching.
I'm going to take the reins back for Michael here and start off on this first C in the top left, coaching. So now that you're familiar with the concept of the 4 C's of financial planning, let's look at reason number 1, why someone might hire a financial planner. Reason number 1, like I said, is coaching. As you can see on the slide, this involves being a trusted advisor, someone who aids in the efforts to adhere towards your plan and goals, and someone who can really help manage the emotions, biases, and stress that may cloud rational decision-making when looking for the optimal investment experience. So one of our primary roles as a coach is one of an educator. This isn't often advertised in the industry, often talks about people wanting to look for an advisor for looking for excess return on an index. Well, we prefer to educate our clients, help them make the most informed decisions they can, and have them focus on what really matters, which is accomplishing their goals. We understand that not everyone is fascinated by the stock market or can describe what efficient market hypothesis is. That's something that we are familiar with when people might not be that interested in. But we do aim to help our clients understand what we are recommending so that they can make a better informed decision. And part of this education process is handling reactions to breaking news with clients and how that affects stock markets and ultimately their portfolio. On the left side of this slide, you'll see some of the frequent themes discussed on TV or published in the newspapers about the economy and markets. Oftentimes, these headlines can quickly invoke a reaction from an investor and trigger them to respond. Did you know that it takes 12 milliseconds for the emotional side of your brain to react to an outside stimulus? It takes 40 milliseconds for that same stimulus to reach the logical side of your brain. This might seem negligible in terms of time, but relative to one another, 12 and 40 milliseconds is a dramatic difference in reaction time. This is important because it tells us that the emotional side of your brain reacts even before the same information is processed by the logical side. This is how impulse decisions are made, and as part of our role as advisors is to manage these emotions and remind clients of their long-term goals and desires. So we have a second polling question here. If you all could take a little bit to answer that one for us. Excellent. So there is no right or wrong answer to this slide, but it's just good to know that everyone's human here. Everyone makes decisions based on emotions every once in a while. It may not all be financial, but as humans, we are inherently emotional beings. So as I mentioned before, our brains are really wired to act emotionally before they act logically. This is referred to something that's called the fight or flight response. You know, Brad mentioned that I have a border collie at home who's happily asleep right now, and I'm thankful for that, but who oftentimes when we're out on a walk, he's a pretty anxious guy when he's around strollers and babies in them. So Brad, maybe we don't come over and see Eleanor anytime soon, but I'm not sure what that's all about and why that's so threatening to him, but I can immediately see that his fight or flight response kicks in because he wants to leave as fast as he can. He's not even looking at me. He's thinking about how this baby carriage could possibly harm him. All that he's thinking about is that I want to get out of here. This kind of behavior in the investing world can lead to selling when the market drops and other irrational behavior. When we take a step back and really think about the long term and better analyze the situation after we've processed that emotional state, this often eases the client of their emotional situation and hopefully makes that investing experience more manageable. As we all know, there are plenty of ups and downs with investing. As humans that respond with emotion before logic, we simply aren't wired for disciplined investing. There's so much going on in our brains, as you can see on this graphic here. Having a financial advisor to coach you through these times is crucial for a lot of investors. A typical investment experience follows something that looks like the graphic on the screen here. It starts with optimism and then elation when the economy and the markets are humming along. GDP growth at an all-time high. Stock markets at an all-time high. Maybe there's a market correction where nervousness sets in. Then maybe fear that turns from a correction into a recession occurs. As history has shown, both markets and the economy bounce back after these recessions, leading to the potential for further optimism about the future and the prospects of the economy. This emotional sequence is often magnified by what is something that's called herd mentality. Herd mentality is the tendency for people's behavior to conform to the groups that they belong to. In times of optimism, you might be talking with your friends about what investments they are buying and what they think is going to happen next. This encourages you to consider investing in what they are buying. As humans, we are very group-oriented and want to follow others. This concept also applies at the bottom of the sequence when fear factors in. Back in March 2020, not so long ago, when markets were descending so quickly as the COVID pandemic was declared, people were panicking and worried about their investments, and rightly so. Because markets fell so swiftly, investors felt that, quote unquote, everyone was getting out of the market and that they had to protect their hard-earned money before other people got out. This herding effect contributes to massive sell-offs like this and often pushes markets down further. With the benefit of hindsight, if having an investor alongside them during this time, it can help manage these emotions and educate investors on the markets and how they've responded to crises in the past similar like this. This can lead to a better investment experience for the client for the long term. Taking a look at this simple sketch here, I'm going to talk about, you might be asking yourself, what is this graphic describing here? What is this behavior gap that's the difference between these returns here? This is something that we like to call the behavior gap. And essentially, the most important piece of an investment experience is the client's saving and investing behavior, which an advisor can assist with but can't control. Ultimately, we have to abide by a client's wishes to get in or out of the market, whether that it's in the context of the COVID pandemic, as I just mentioned. If a client wants to get out of the market, we can't say no to them. We can try to coach them and give them perspectives and that they might take into consideration, but we can't always control what the client wants to do. And what I mean by this behavior gap specifically, a good example is if you see a 10-year return for a mutual fund and that's 8%, that means you put all of that money in on day one and left it there for 10 years. You'd have earned that 8% minus any fees. That's not how everybody invests though. So some investors look around for that next great investment. Maybe you're talking with your friends and they're talking about this. I was watching March Madness all weekend and the commercial I saw over and over was Invesco's QQQ ETF. And if everyone's talking about that, why wouldn't you want to get in that? So maybe you switch from your emerging markets fund or international funds and put this in a technology fund. Maybe you switch a strategy from growth-oriented companies to value-oriented companies. By doing so, you might not get that same investment return that you see on this left side as if you held that position for 10 years. You might get this investor return if you were to flip back and forth, because flipping back and forth can not only generate fees and costs, but you're not going to get that achieving that investment's true return by by doing these knee-jerk reactions to any market movements, or just trying to outguess the market and pick these certain things that you think may outperform. Lastly, I'm going to talk about adhering to your stated goals. Another graphic here on this slide puts it in perspective for you. A lot of people talk about beating some index, but what we like to coach is the most important thing is about reaching your goals. We work with clients to define what their goals are and what they value most, so we can help put a plan in place for them to achieve them. Some years you might beat an index by a landslide. Other times you might lag it for a year or so. It isn't a guarantee that you beat one. As an advisor, it's part of our job to not only monitor a client's investment portfolio and maximize returns, but we also have to take into account the bigger picture when it comes to their financial lives. I mean, no one's ever going to turn down beating an index, and that's a wonderful thing. But do they have enough for life insurance in case something were to happen to them? Do they have an education funding plan for their children? Are they making the best financial decisions while also minimizing taxes? Being a holistic advisor is not only assessing portfolio performance relative to a benchmark, but rather, are they reaching their goals? That's what really matters. And being a financial coach, rather than being solely an investment advisor, this can differentiate a client experience from another one. I'm going to pass it back to Brad so we can look at how impulse decisions can have a drastic effect on your portfolio, and also take a look back at world events and how the stock market has dealt with those various disruptions.
Thanks, Derek. Yeah, so we've been talking a lot about behavior and emotion, and really what we're illustrating here is just the nervousness involved, right? Following that elation, the nervousness, and showing the impact that it has in your portfolio. If we stay in the market, is that far bright green column. And then if we miss a couple of the best days in the market, if we miss 5 of the best single days in the market, you can see the impact that it has on the overall portfolio, right? It drops 1.5%, almost 1.5%. And the most difficult number on the screen to digest is, what if you missed a longer period of time, like 26 or 25 of the best days? You're watching what would have been almost a 10% annualized return drop all the way down to 5%. So you're cutting it in half, and that's because or the individual was nervous and panicked and wanted to move money out of here. It would be the index, so out of their equities, and maybe they went to cash because they were seeing just this overall negative dialogue, in the news, and hearing their neighbor talk about it. And then the next, so when Derek mentioned current events, the next slide really hits on all of the things that we've heard, right? Since 1970, all the way out, what happens and the impact that it actually has on the dollar, right? Because oftentimes we hear the negative side of something, or sometimes we hear, the accurate side of what's actually taking place, but maybe we don't have our long-term goals in mind. Maybe we're worried about what's going to happen right now. And, we hear the S&P is going to drop 46%, and we immediately move to cash. And then we miss the upside and we miss the rally. We hear about Brexit and how the impact that's going to, ripple through the American stock market. We start to hear about Japan and their melt up, and what does that mean? And are we going to go through a similar market crisis? Then we hear about COVID. And so we start to get very, very nervous. And I think it's interesting because growing wealth, there's no shortcuts to it, right? Sticking to a plan is ultimately what needs to take place in order to get to where you want to be. Timing the market, in order for someone to be accurate when they try to time the market and to be active in the management of money, if that person is right, it means that everybody else is wrong, right? Because that's the only way that they can take advantage of the market. So the scholars, the Nobel Prize winners from the University of Chicago, where the efficient market came out of, right? They would have to be wrong if an active manager is to make money in their portfolios during times like this. And so I think, this goes back to that nervousness, right? If we're confident in the overall plan and it's designed to ultimately meet those long-term goals, maybe we don't have as much nervousness or nerves in the market. And, Michael has sat in on plenty of meetings with me, and I say this to all of my clients. I'm sure, if I've spoken to anybody on this phone, you've probably heard me say it as well, is that, and it catches people off guard when I say it, but I do say, look, I do not care if I can get you 15% in your portfolio. And it's true, right? If I only need to try to manage your money to get you 7, 8, 9%, and your plan still succeeds, right? Based on all those Monte Carlo scenarios that Derek showed you earlier, if the plan still succeeds, then why are we taking undue risk, right? And so we see that a lot of times in people's plans, is that we get laser focused on trying to beat a benchmark or an index, or we're talking to our neighbors about this super attractive NASDAQ fund or something that we want to get into because it's up 46% for the year. Well, if we take it and we look at it like this, if I told you, if you said, I need $100,000 to live on, that's what my plan needs. And I said, okay, well, we can take a job that will pay you $150,000 a year, but you have to drive to the office 100 miles an hour. Or I'll give you a job where you can make $125,000 a year and you get to drive the speed limit to work. Most people would take the $125,000, the second offering. Now there's risk in both, right? Because on the way to the office, something could happen. We can't control all of the risk associated with it, but we can mitigate a good bulk of risk by just driving the speed limit, by just staying on target, adhering to the plan, and we still benefit. We still get to have what we need for retirement. And I think that that's the biggest point here. Okay, another polling question. Do you review your financial plan regularly? Great. So out of the 78% of people that have a plan, 63% of those review it regularly, which is terrific. That's what should be done. All right. So we wanted to throw in a few different case studies, some real world events. And this is actually, this is a real life example. This is a client of mine. And so before we get into the meat of it, as Derek mentioned earlier, we can't do anything sometimes if the client wants out, right? We can only advise and give as much expertise as possible, but at the end of the day, it is ultimately the client's decision. And so this, in my opinion, is a perfect example of looking at a plan and sort of neglecting the long-term goal of that overall plan. So this example, the first paragraph, and I think we all know, is that during COVID, the market declined significantly in March, several times in March, 7.6, 9.5, and almost 12%. So my client, mid-60s, had, I think it was more like 5 discussions with this client. Yeah, Michael's nodding his head. And he wanted to pull out a portion of his portfolio and go to cash. So I wanted to understand the why, and he felt like the market was still going to continue downward and we weren't at the bottom yet. I gave pushback. He gave more pushback. I gave pushback, and then ultimately his pushback trumped my pushback. And so just to quantify the impact of this plan overall, the S&P's gone up 49.96%. And by the way, he kept this money out of the market all the way from the bottom, April 3rd, all the way until basically the start of this year. So that $500,000, if it would have remained invested after it would have gone down, it would have come all the way back up to 746 and some change. Now, we're just talking about the overall asset value, right? But if I look at his financial plan, right, and I rerun Monte Carlos all the time for my clients, if I look at his plan, the impact that it has is that the 92% success rate that it had, it dropped all the way down to 88%. Now, to Derek's point, anything over 85%, we say, okay, it will succeed, it will be fine. But giving up 4% of a success rate because of nervousness and everything else like that, when we know that in the long run, the market would recover, right? And again, we're back testing data here so we can discriminate and throw out certain things. And but in the long haul, the one thing that doesn't lie is his plan, right? And that overall plan would have been in a better position had we stayed the course initially, which was the encouragement. So Michael talked about it earlier, right? Certain people fall into different buckets. Sometimes someone falls into multiple buckets here, but continuity is probably the vast majority of clients that I come across. You know, I am heavier on the insurance side. I cut my teeth in that industry after running a CPA firm for a while. And so I get brought in as the subject matter expert quite a bit as far as insurance is concerned. But really what we're talking about is sort of that family continuation, right? And the involvement. Does your family know about a plan? Do they know what to do if you're no longer around? And so, you know, the next polling question. Yeah, so the national average is 16.8% of of people providing care to someone over the age of 50. And I ran the quick math right as soon as I saw how many participants were on here, and that would have been 5.5% or 5.5 total people. So 5.5 people, 5 to 6 people, and we have 5 people. So yeah, I mean, it's an astounding number. So one of the things, when we look at that data, and then, the reason we have disability income up here is because these are, even though they're not ways to warehouse and to sort of stockpile assets, insurance is a great tool when used properly to safeguard against the erosion of an asset, the spend down of an asset, or an asset even coming to you in the first place. And so with disability and income insurance, I know that the vast majority of folks on the line have coverage through the club, through a club or through an association. And so, what's interesting is that we were forced in certain situations, but in other situations, we insure the golden eggs, right? We're always insuring our home, our auto, valuable personal property. But very rarely do people go above and beyond to insure the golden goose, which is ourselves, right? Our income. And if we don't have that income and a disability takes place, your financial plan is completely derailed, right? We see it time and time again, because during your high earning years, that plan needs to be fed so that it doesn't starve later during retirement. And so with disability insurance, one of the astounding statistics is that top one. 46% of foreclosures take place because of disability, and only 2% is a homeowner's death. But at the same time, there's a vast majority of Americans that carry life insurance, but no disability insurance. And a lot of the disability plans that we encounter are through employers. And sometimes there's a gap, right? So, let's say it does offer 60% of your base salary, but it's paid for by the company, the club in this situation. Well, that turns into a taxable event to you if disability ever takes place. That monthly benefit is taxed, and it's usually only 60% of your salary. So that 60% turns into about 40%. And when a mortgage company is going to say, hey, you're defaulting on this loan, it's not like they come to you and say, okay, you can live in 40% of your house. You can use the upstairs bathroom and the microwave and the refrigerator, but you can't use anything else, right? They don't discriminate. And so what we do and what advisors that you're working with should be doing is looking at how a disability would impact the overall Monte Carlo scenario inside of your financial plan. And then running scenarios inside of that financial plan that will show the replenishment of income if something were to take place. And really settling in on a sweet spot of that financial plan. Because what you don't want to do is have too much insurance, right? But you also don't want to have too little. You want the plan to work with just the optimal amount of insurance as far as disability insurance is concerned. Long-term care insurance. So when we are talking about having to feed the financial plan early on in the high earning years, the income is super important to an individual. Well, the number one drain on assets that have already been sort of put in the vault and earmarked for later, the number one drain is long-term care expenses, right? I mean, we're talking astronomically high numbers as far as, if you just need basic care, skilled nursing, if you're in a facility, the assisted living. So then if you layer on top something like Alzheimer's or dementia, it compounds and gets extremely, extremely expensive. And so if we know that 70% of people turning age 65 are going to need some sort of long-term care service in their lives, we owe it. And I say we, PB mayors, we owe it to our clients, our prospects, and quite frankly, anybody that we talk about or talk to encourage them to at least look at it, right? And so I don't, and this is interesting, is that I don't necessarily care if someone comes to me and says, hey, can you help me find long-term care insurance? I absolutely will do that. That would be terrific. At the end of the day, I care that that person is just looking somewhere for it. Right? Because it is terrible to watch a plan fall off the tracks because something happens from long-term care perspective and it could have been taken care of. And so below that, you see the average durations of care. So 3.7, 2.2. If you are talking to someone who is quoting long-term care insurance, do not let them quote you a lifetime benefit. They are very, very expensive. If you already have one, that's great, because you probably got it a long time ago. But they are currently, actually, I don't even know if carriers offer it now, but if they talk to you about a duration that's a lot longer than 3.7 or 2.2 years, question it, because you don't need to be paying an exorbitant amount of premium, right? Cash flow now to cover a benefit that is statistically very unlikely to take place. So this right here is the cost of care. You can see that 63% of people actually don't have an out-of-pocket long-term care expense during their lifetime. Now, that's a little bit of a misleading percentage, right? Because we've determined earlier that 16% are being given care by loved ones, right? So we can throw out a little bit of the sample size there. But then we look at, 9%, $250,000 or more during their lifetimes. Right now, and this is, Virginia numbers, but we're looking at $300 a day here. It is extremely expensive. The IRS per diem is slightly below 400. And so being able to cover some sort of long-term care exposure in the future is worth looking into as part of making sure that your plan is bulletproof. And when I say that, I don't think that you have to break the bank to get this done. There's multiple strategies that can be put in place where it's a life insurance and a long-term care hybrid product, which is a little bit easier to obtain than just a standalone long-term care insurance policy. But of course, if you want to ask us or email us, we can point you in the right direction for some resources to read a little bit more about it, because I really think that there's an education gap as far as long-term care is concerned. And here it is, we touched on it a little bit, that 63% of people that don't have out of pocket. This is more numbers as far as who's offering the care. 16 million people providing unpaid care to someone with Alzheimer's or another cognitive impairment. 470 billion, the estimated dollar value of long-term care provided by unpaid caregivers in 2013. So, I mean, fast forward 8 years until now, that number, it's got to be astronomically higher. So really, we talked earlier about wealth enhancement, and then here we're talking about wealth protection, right? Trying to preserve those assets, trying to warehouse and stockpile extra income and cash and make the plan grow. And then, we'll talk a little bit later about this transfer of assets, right? You'd be either to the family or through a charitable giving program. They have a vast number of ways to transition wealth and sort of the effective way to do it. But none of that matters unless we protect it first. So a little bit more just about protection, some of the estate documents that, work into a plan. And I'm sure those of you that have plans have this as well, but we have a portal in our planning software that allows us to upload wills and power of attorneys and trusts of all sorts. And so it's nice because it's all tied in one place. And then if the advisor needs to jump in and grab it and look at something and the impact of the plan overall, it's easier to do. But if you have documents like this that are not updated or that you haven't done in a while, that you haven't reviewed, just take a little bit of time so that every time you review your financial plan, you're kind of looking back into these documents to make sure that they're still up to date, they're still accurate, beneficiaries are still, accurate. Those are all very important parts. Great. So about that question a little bit is that, clubs, businesses, they all have continuation plans. And what's interesting is that the ultra high net worth individuals that we work with treat their families like a business, which is probably why their children turn into entitled contributing members of society. But so if our families are as important to us as we think, and as we tell everybody, my family's so important. If they're that important, then we should really, really come up with continuation plans for that. So now Michael's going to talk to you a little bit about the family love letter.
Thanks, Brad. Yeah, one of the things that we've been doing for our clients is the family love letter, which is a continuation planning tool that all of our advisors have been trained to use by the creator, Donna Pagano. She was actually a CFP years ago who noticed that a lot of her clients' families really were not involved in the financial picture, whether it was just mom or just dad that she was operating with. If something were to happen to them, children, grandchildren, cousins, nephews, nobody else really understood what was going on. So it's pretty simple what it is. It's essentially a well-structured plan for someone's legacy. Sometimes it's a difficult conversation for us to have. Many people don't want to think that far ahead to end of life, but it's a really important conversation to have. And this tool is really valuable to the people that we leave behind. It's meant to offer information and clarity during some of the most confusing times of our lives after our family loses a loved one. It can organize a paper trail across your entire lifetime, touching on each aspect of your life, your financial life, your personal life, and aggregating all of this information for your family. So that way, when someone does pass, your family members have access to all of your documents, passwords, websites. There's a lot of little things that we don't think about. Something as simple as if someone passes away, well, how do I access the investment accounts? I don't have the login for Charles Schwab. This aggregates everything into one place, as well as the important values that we want to pass on to the next generation. And having a plan like this can sometimes also help limit maybe interfamily conflict that can arise after an important patriarch or matriarch passes.
Yeah, so to get back into the continuity as far as long-term care is concerned, here's a little case study that we wanted to share. So another real life story. The gentleman was 66, retired general from the Army, went to work for the DLA. So as this states, retired with a government pension as well as a military pension, assets in a TSP, and some life insurance, and thankfully long-term care insurance. Because at 69 he was diagnosed with Alzheimer's. It accelerated quickly. He's now 74, and paying for care for those. So the spouse took care of him until he was 70 and a half, really. And then it became a little bit too much. And so he's been in an assisted living facility since he was 70 and a half and all the way until 74. And that it's very expensive because it's a cognitive wing. And yeah, I mean, it runs on average about $7,600 a month. And I know all of this, and I'm very familiar with all of this because this is my father. And so if you heard me earlier talking about long-term care and sort of this unrelenting tone and very unapologetic about people looking at long-term care, it's because I faced it and my family deals with it daily. So now I'm going to throw it back to Michael to handle convenience.
So the fourth C or the third C that we have here, convenience. A lot of our clients understand, that their time is valuable. They don't want to be spending their time stressing, worrying, thinking about their financial picture. Working with an advisor alleviates a lot of that burden. It allows the client to put some of the stress of their financial life onto us as advisors, the experts, so that way they can focus on their own peace of mind. Okay. So over half.
So statistically, according to CNBC, 75% of people say they manage their own finances.
Derek, if you could put up the first two here. something that we like to tell our clients when we show them a slide like this is, let us handle these first two boxes. Let us focus on the financial aspects of your life. And then the next two is what we tell our clients to focus on. Focus on what matters most to you, your own peace of mind, your own fulfillment. Let us worry about cash flow, financial planning, investment management, rebalancing your portfolio, making sure that you're still on track. So at the end of the day, your plan is still successful. You're not going to run out of money. Everything's going to be fine. One of the ways that we do this is using a financial data aggregator. We try to simplify our clients' lives as much as we can. Brad touched earlier on about something like eMoney. That's the financial planning software that we use. We can compile all of our clients' financial information. We can compile their documents, important trust and estate documents. We can have them in the vault. And this also has a client portal that allows our clients to access it whenever they'd like, and they can see where their plan is, whether they're still on track. They're able to monitor their spending and make sure that things are still running the way that they should be running. Talking a little bit about tax alpha, something that we do for our clients that maybe broker dealers and other advisors aren't always doing. Us coming from a CPA firm, we would be remiss to not focus on tax saving as much as possible. We always look at things from a tax saving perspective. We want our tax efficient versus our inefficient investments in their respective taxable and tax deferred accounts, so that way we can minimize taxable income for our clients as much as possible. And speaking of taxes, we coordinate with our clients' CPAs, especially, like I said, with us being in the wealth management side of a CPA firm at large. We work hand in hand with the accounting partners to ensure that our clients are getting the highest level of service from both a wealth management and a tax saving perspective. We always joke about how, Brad can walk across the hall to a tax partner in Fairfax and ask him the most complicated tax question in the world, and we can get an answer just like that for our clients. And on top of that, we're able to play quarterback with some of the other trusted professionals in a client's life, with an attorney or a banker or anybody else that we need to play quarterback with. We can run the operation, taking the burden off of the client themselves. So this is an example, again, a real world client of ours. Just using this as an example, this client was retired, they're living in Virginia and they wanted to purchase a second home in Florida. But since they're currently retired, they don't have currently any income. That's going to make getting a favorable rate pretty difficult. So what kind of options does the client have? Well, working with an advisor, we're able to take advantage of what's called an SBL, a securities-backed line of credit. And so what this does is it takes your investment portfolio and it uses it as collateral for the line of credit that you're able to draw upon for any cash needs that you want, purchasing a house, purchasing a car, anything. And you're able to do this without liquidating your investments. You don't create a taxable event, and your investments are able to stay invested and continue appreciating. In times like this, with low interest rate environments, we've seen that we've been able to get clients rates as low as just over 2% for a line of credit, compared to a traditional mortgage of nearly 4%. And this is something that we operate totally on our own from. We coordinate with bankers from US Bank and Fidelity in order to get this done. It's incredibly easy for the client, and they're able to secure a mortgage for a new home.
And just a quick point while people are answering this question is that, Michael just touched on which software PB Mayors uses and how PB Mayors uses Tax Alpha and PB Mayors and SBL. I want everybody to know that this is not about PB Mayors. I think that when we give a presentation like this, it's us purely trying to say, this is what you as the client, this is what your expectation of your advisor should be. So I just wanted to kind of throw that out there. All right, 0 to 2. That is right on par. So data shows that the average American spends less than 2 minutes per day focused on their own finances, which is a foreign concept to me because I spend, at minimum 8 hours a day focused on somebody else's finances. So, but yeah, that's right on par. That's what we expected to see. Kurt?
Thanks. I'm going to begin by reading you two different quotes. Lee Lu, the manager of Himalaya Capital Management, says a competence that has no defined borders cannot be called a true competence. Lawrence J. Peter, an educator who is often quoted in business schools across the world, says competence, like truth, beauty, and contact lenses, is in the eye of the beholder. Good afternoon, I'm Kurtis Johnson, and I'm going to pick up the conversation and talk about competence as it relates to financial planning. This slide lists several financial planning tasks and goals a financial planner, either a professional or an individual amateur investor doing it on their own, is likely to be called upon to perform. Holistic asset integration, investment selection and monitoring, risk management, generating income strategies, tax and estate considerations, and other specialized expertise. Listing these tasks and defining them is helpful, but when we talk about end results and how those results get achieved, the need for competence should become self-evident. For the next several minutes, I'm going to talk about two specific financial planning competencies while making some comparisons with some competing planning strategies. But first, I think we have another polling question. Are you confident with your current investment strategy? Okay, so 63% say yes and 37% say no. Brad, did you have any comments you wanted to make on those figures?
Of course. So Motley Fool, where everybody goes for accurate news, right, says that 27% of people are confident in their current investment strategy.
Well, let's get started with what's perhaps the heart of investing, investment selection strategies. Anecdotally, I find that most individual investors have never considered what investment strategies are available to them or with which strategy they most strongly identify. Competence at investment selection with a particular investment strategy is of extreme importance to any financial plan. Also of great importance is risk identification and management. While my first slide identified several competencies needed by someone engaged in financial planning, for the sake of time, I'm going to focus on these two today. There are different approaches to investing when we talk about investment strategies. The active or conventional investment approach assumes that prices are not accurate and that individual security selection can be executed profitably on a consistent basis. This leads to an attempt to predict the future, which can generate higher costs and potentially higher risk. The challenge with making predictions about the future is that investors, to implement a profitable trading strategy, must not only predict future events, but also predict how markets will react to those future events. Consider this illustration of how conventional managers invest. This box represents the entire stock market universe, and the dots are individual stocks. A manager buys a handful of securities expected to do well in the future and sells securities expected not to perform well. The portfolio performance depends in large part on how effectively the conventional manager has predicted the future. Note that this type of manager starts with nothing and finds a reason to pick one stock over another. The manager's selection criteria are based on whether the stock is considered overpriced or underpriced. But choosing only a few stocks in the market often results in poor diversification and higher risk. Equally important, the manager's frequent buying and selling results in high costs as the portfolio is turned over many times. Indexing is the next strategy to consider and offers a number of investment benefits over a conventional approach. Broad-based indexes offer better diversification, have lower fees, and follow a more transparent investment process, which means investors have a clearer idea of what they are getting. The problem with indexing is that the commercial index provider determines the investments held in the index. The firm publishes a list, usually annually or semi-annually, containing all the investments composing that index or benchmark. The manager attempts to closely track the benchmark, but rigid construction can work against the strategy. Most index fund managers are judged by their ability to closely track their respective index. The main problem with this approach are loss of control and trading disadvantages. So what do I mean by loss of control and trading disadvantages? By loss of control, what I mean is an index manager does not start with the whole market, but with a list of stocks published by the index provider. The manager holds a basket of stocks in an attempt to match or closely replicate that list. The investment strategy is defined by a commercial index provider, and the manager has no control over what the funds holds. When I say trading disadvantage, what I mean is when the new list is released, managers must buy and sell at the same time to keep their portfolios and returns in line with the index. This updating process is known as rebalancing or index reconstitution. Everyone knows what the index fund is holding and when the index manager will rebalance. The index provider has shown his cards or her cards to the marketplace, and the index fund manager will have to trade with urgency along with other managers who follow the index. This puts the managers at a trading disadvantage, which usually results in higher costs. Another challenge faced by indexing proponents is controlling style drift. Style drift happens when security prices change every day to reflect the market's latest expectations, but indices rebalance only once or twice a year. As new information is incorporated into market prices and securities start to exhibit different characteristics, the index portfolio can move away from its target universe or asset class. This is referred to as style drift, and it happens to indices between reconstitution dates, leaving investors to hold stocks they may not want to own. There is an alternative approach to both conventional management and indexing. This approach is informed by a view that market prices reflect all available information. We believe that different securities can have different expected returns. We can use the information contained in market prices to understand which investments have higher expected returns. Guided by this perspective, this approach looks to academic research to gain insight into the dimensions that drive those expected returns, then integrates this knowledge into strategies designed and implemented to add value in competitive markets. Our firm, PB Mayers, is a proponent of this strategy. Decades of academic research have pointed to systematic differences in expected returns. We can consider them dimensions of expected return if we can structure portfolios to target them and add value for clients. By their definition, dimensions of expected return are sensible, backed by empirical evidence, and can be captured cost effectively. Since the dimensions meet these criteria, we have greater confidence it will continue in the future and is worth pursuing in real portfolios. In the equity markets, we have identified 4 dimensions of expected returns. The equity premium says stocks pay a premium compared to bonds. The company size premium says small company stocks pay a premium compared to large company stocks. The relative price premium says value stocks pay a premium compared to growth stocks. And the profitability premium says that high profit companies pay a premium compared to low profit companies. So if there are systematic differences in expected returns and research has identified them, how can the insight be applied to practical investing? We select broadly diversified portfolios that emphasize areas offering the potential for higher expected return. The strategies can emphasize securities with higher expected returns by overweighting them compared to their market cap weight. One way to visualize overweighting is to think about an ice cube tray with sections that are shallower and deeper. In a portfolio, each section holds many stocks that compose a market area, and those with greater return potential are overweighted, just like the large ice cubes. In a dimensions-based approach, capturing returns does not involve predicting which stocks, bonds, or market areas are going to outperform in the future. Rather, the goal is to hold well-diversified portfolios that emphasize dimensions of higher expected returns and have lower turnover. Let's move on to managing risk in a portfolio. Here's a slide that lists several kinds of risks an investor has to contend with. A financial planner has to be competent in managing and mitigating these risks where possible. Market risk. this risk is the this risk is the chance that an investor will experience losses due to the overall performance of the stock market. Think about the market crash in 2008. Also called systematic risk, this risk cannot be eliminated through diversification. This is just the cost to play the game with the market. Purchasing power risk, inflation in other words. This risk is often associated with low interest-bearing investments or fixed income type securities like bonds, CDs, and savings accounts. This risk describes how the rising cost of goods and services can outpace the interest paid on an investment. If inflation is 7% and your CD is only paying 2%, then at the end of the year, your dollar will only buy 95% of what it could have before it was invested. Next is interest rate risk. That's the risk. Interest rate risk is the risk of fluctuations in security prices due to changes in market interest rates. And a branch of this is reinvestment risk, or the inability of investors to know what interest rates will be when proceeds of fixed income securities mature. Exchange rate risk is the risk that you will experience variability in earnings resulting from changes in monetary exchange rates. Business risk is concerned with fluctuations due to good or bad management decision-making, or how well or poorly a firm's products are doing in the market. Examples include bankruptcy, laying off workers, etc. Financial risk is risk of firms using debt, experiencing cash flow problems that mean they can't make payments on that debt, and subsequently defaulting on that debt, harming lenders and investors. Political and regulatory risk results from unanticipated changes in tax and legal environments imposed by the government. This is a bit of a hybrid risk because some forms can be systematic, such as changes in tax laws, and some forms can be unsystematic, like changes in environmental laws. External risks aren't the only risks a financial planner must consider. Investor behaviors, assumptions, and biases can also threaten long-term portfolio performance. For example, home bias is the tendency for investors to invest the majority of their portfolio in domestic equities, ignoring the benefits of diversifying into foreign equities. Most of the risks we discussed in the previous slide can be mitigated in some way through diversification on a global scale. Someone engaged in financial planning needs to be aware of investor behavior, biases, and have strategies that can be brought to bear to mitigate these threats to long-term performance. This slide shows that while 54% of the global stock market is based in the US, the other 46%, almost half of all opportunities, can be found abroad. This table ranks annual stock market performance in US dollar terms for 22 different global markets from highest to lowest over the past 20 years. The colors correspond to the countries featured on the next slide, and the patchwork dispersion of colors shows no predictable pattern. Investors who follow a structured, diversified strategy are more likely to capture the returns wherever they happen to occur in markets around the world. This table shows annual performance in US dollar terms of 22 developed country stock markets for the past 20 years, highlighting the top performer in each calendar year. The random results illustrate the lack of predictability in market performance by country. The annual ranked returns show no obvious pattern that can be exploited for excess profits, strengthening the case for broad diversification across the world equity markets. Note that the US had the highest annual ranked performance over the past 20 years just once, back in 2014. The lack of predictability presented in these slides illustrates the need for a competent financial planner using a well thought out and rational strategy. I think that takes us to our next polling question. Have you reviewed an analysis of your portfolio within the last 12 months? All right, so 44% of you said yes, and 56% of you said no. And Brad is the man with the statistics. Brad, do you have anything to comment on those numbers?
Yeah, so for this polling question, I thought it was, are you still awake after Kurt just talked about systematic and unsystematic risk? So I don't necessarily have any data pertaining to your review of your portfolio or not.
All right. All right. So my last slide brings us to my final comments. Personal financial planning isn't the only time the people attending this presentation will need the competencies outlined in the previous slides. Many of you are likely responsible for the 401k or 403b plan sponsored by your club. ERISA requires a 401k plan to hire an advisor if there is no company employee who possesses the required competencies to effectively select and monitor investments on behalf of the employer's plan. A good 401k advisor is someone who you should be able to rely on to provide a backstop of competency as you select the investment and risk mitigation strategies your employees will depend on to build their own retirements. Some advisors, PB Mayors included, are even willing to assume responsibility as a qualified fiduciary for sole responsibility in the eyes of ERISA and the Department of Labor over the selection and monitoring of your plan investment menu. There have been studies that indicate most 401k plan advisors are not specialists in the field of advising 401k plans and may only advise one or two plans overall. There are professional certifications that demonstrate a minimum level of advisor competency you can consider using to determine if a 401k plan advisor is up to the job. The AIF designation, accredited investment fiduciary, or the CPFA designation, the certified plan fiduciary advisor, are the two most common designations. I personally hold the CPFA designation. And again, this is not the PB Mayor show like Brad said, but would be available to consult on your 401k plan if anybody had any questions about that offline. And with that, I think I'm supposed to turn it over to Brad now.
Yeah, so I think, we hit time right on the head, and it was good walking through coaching and continuity and convenience and competence. And, I think at the end of the day, we just wanted to try to be as educational as possible, and maybe to try to set some expectations for what people should be seeking with a financial advisor engagement, or what they should be looking at in their own financial plan if they are the one that manages the assets and sort of has the overall plan. The next slide has our contact information on there. If you have a question, you can, I speak for the team, you can ping any one of us and ask us a quick question, and we'll get back to you. We're not going to send you a bill. We're not going to do anything else like that. We are here to help at the end of the day. And sometimes people don't recognize that, I guess, right? That they think that we're in the financial arena and they're used to that broker dealer engagement where people take commission, and we don't do any of that. So we're here purely to try to advise and give some education and some knowledge around things. So I really appreciate it. Andrew, thank you for the invite. And I think we'll wrap up now. I don't know if we have to talk for 8 more minutes. I'm sure we can find something to talk about, but I don't know, Andrew, what your thought is now about wrapping up the meeting.
I certainly think we can. I'd like to thank you, Brad, and the